Hello, and welcome to the property market update for Victoria from realestate.com.au. I'm Luc Redman, an economist here at REA Group, and I'll be taking you through the property market update for the state of Victoria today. To that end, we'll begin with the agenda and we'll start with economic conditions, the current housing market. Then we'll go into something that's very topical at the moment, investor activity and the budget changes. And then we'll finish off with a bit of an outlook from REA and how we think the housing market is going to evolve over the short term. Starting with economic conditions, inflation seems to be and will continue to be the main topic of conversation within the economy moving forward. It's been quite persistent since 2022, and even with the RBA's responses to inflation, we haven't actually been able to get back into the target band. So what we're looking at here is the consumer price index, which is the basket of goods that households purchase within the economy. There's two lines here. The first one, the red one, which is headline CPI, which is essentially the price point that households feel within the economy and the things that they tend to purchase. The trim mean, the light blue line, which is the RBA's preferred measure of inflation, that essentially takes the top 15% and bottom 15% of price movements within the basket of the headline CPI to get a bit of a core underlying idea of how inflation's evolving within the economy. So that's the preferred measure of inflation for the RBA. And the reason why that is because it removes a lot of volatility within the index. So you see there's whenever it peaks, whenever headline peaks, trim mean is a bit below it, and whenever it drops quite dramatically or down, trim mean tends to be a bit above it. So you kind of get this flattening to understand the general direction of where inflation is heading across the broad economy, rather than being more heavily weighted by some outliers products within or services in terms of price growth. The grey area that you see on the chart, that's the RBA's 2 to 3% target band. And that's essentially the area where they want these two lines, or at least the blue line, to be sitting at. What you see with those two dashed lines, the light blue dashed line and the red dashed line, is the RBA's forecast at the last meeting of where they expected inflation to kind of go over the medium term. So to that end, they don't actually expect inflation to come back to within the target band under their preferred measure until middle of 2027. And in terms of headline, not until about early 2027 or around about that time. So that means inflation's going to be still running relatively hot over the next little while, with any policy response from the RBA going to be critical to that direction. The key reason why they expect this and the reason and the drivers behind it has been domestically driven inflation over what has been compared to what has been happening overseas. So the red line that we're looking at here is non-tradables, which is domestic inflation factors or domestically driven prices within the economy. So when you consider non-tradables, those are things like electricity, rent, hairdressing, pharmaceuticals, things that are determined by Australia and the price point in Australia. Tradables, they're things that are determined on international markets and international competition. So think of them as things that we kind of import and export. So importing like TVs and those sorts of things from overseas, they're kind of tradables. And that takes up about a third of the consumer price index in terms of the weight of the basket. The key thing to look at here is the red line only really just touched the target band over recent history, and has since risen quite dramatically to around about 4.7%, and has touched up at 5%. So that's essentially meant that there's quite strong price growth within the domestic factors of the Australian economy. And what you see with the light blue line is that it was doing a lot of the legwork underneath that inflation driver. So that light blue line sits below the target band, which was pulling a lot of downward weight on inflation for us, combined with the general direction of the non-tradables, the red line. Since then, since the RBA eased interest rates, both have kind of rebounded and accelerated in some direction. And there is a view from the RBA that there's quite a lot of stickiness within the Australian economy and a lot of capacity constraints, i.e. we can't make enough goods and services to what we actually demand domestically. What you see with that light blue line is quite a big spike recently and then a drop off. That's basically the Iran war and oil price driven. And essentially those oil prices spiked quite dramatically, as we were all no doubt aware. And they've come off a little bit recently, given the policy responses and the oil price drop that it drove a lot of those price changes and pulled back. Ultimately, though, the main driver of inflation is still the domestic factors that haven't really moved too much over the last 6 to 9 months or so. That in turn required a bit of a policy response from the RBA, and it's hence why they've increased interest rates 3 times to reach a new level high in recent memory. What we're looking at here is mortgage rates. So these are for new owner occupiers and their variable rates. We're currently sitting at about 6.23% as of the end of March. That's kind of the average rate that a new owner occupier can get from a bank or a non-bank lender. That in recent history is about equal to the highest that we saw when interest rates were at a similar level not long ago, and they were held to kind of bring that inflation back towards target band before we cut and put them into this position and had to reverse and then go back into this position. From recent history, that's quite a significant jump, as you can see, since about 2022 to 2021, when we were at near all-time lows. That is quite significant in terms of the effect on prices. But what we kind of when we take a broader picture of interest rates and look back further, it's actually the equal highest or close to the equal highest that we've seen since 2011, 2012. And that's kind of taking a bit more of a broader view of where the RBA kind of sits and how we kind of see interest rates, because the recency bias of having extremely low interest rates and then them being removed is kind of plays on our expectations of where we think interest rates should be. Because of the increase in interest rates, we have an expectation that unemployment is going to rise as a result. So when the RBA increases interest rates, it's trying to cool demand in the economy. When you consider that in current terms, it's quite a big jump from the low that we saw when in 2021, 2022, when inflation was really high. And that's because inflation and unemployment have an inverse relationship. So when inflation rises, unemployment rate drops. When unemployment rate rises, inflation drops. And that's kind of true across all economics and a lot of central banks around the world. So they use the cash rate to control demand within the economy to cool inflation or increase employment, depending on which direction they're going to go. When you consider the history of this graph that we're looking at here, the unemployment rate back to the late 1970s, we see that we're actually at still quite a historic low level. So when we look back, except pre-GFC time, we're pretty well at the lowest we've ever really been in terms of unemployment rate, which is a really good thing. So there's been quite strong labour market gains. Because of those labour market gains, we actually had relatively strong wage growth, mostly driven by the public sector, but it's been quite strong in over recent times as firms and have competed for labour within the market and have had to bid up wages to get that labour. The light blue line is the forecast that we see from the RBA, which they expect to go up a little bit as inflation comes down and interest rates stay elevated. Though when you take the broader picture of all of that, it's actually still quite a low level than what we kind of expect or have seen in the past, which has supported quite strong household consumption and expenditure. The main problem with that has been that inflation has been too high. So whilst households have been getting real wage gains, are getting wage gains, they've been getting real wage losses because of how high inflation has been, and it's eroding those gains in the pay packet. There are implications of wage price spirals when inflation continues to run hot and wages follows, and we continue to lose sight of how to pull inflation back, but they're kind of quite minor concerns at this point in time. Those strong wage gains and that strong activity from the labour market has kind of been the main thing that supported economic conditions combined with a lot of public sector consumption and spending. What we're looking at here is GDP growth historically since 2015 of Australia. And essentially, the black line is the total GDP growth within each quarter, going up to the most recent quarter in March that we have data for, and the components of those. So net exports in red, private in light blue, and purple being the public sector. And what we see is quite a steady state prior to COVID, then a big shock that had a large fluctuation in private sector expenditure. And then we saw quite a diminishing, um, as we moved to the right, we kind of saw quite a diminishing effect of the private sector in about early to mid 2024. That's since rebounded quite a bit, um, mostly in recent quarters, due to AI and data center investment within Australia. And that's kind of been the main driver behind why the private sector's grown again. Ultimately, prior to that, it had been mostly a fair amount, the 12 to 24 months prior to that, there'd been mostly the public sector doing a lot of the legwork, which meant we had a lot of non-market sector growth and employment, which kind of pushed up a lot of wages as well. Moving to Victoria, population's rebounded quite strongly. Um, what we can see here on the left is the annual population growth for Victoria compared to the annual population growth of Australia. It was outpacing Australia for quite some time, and there was quite strong demand within Victoria for dwellings and new construction investment. That was outpacing Australia up until COVID, where we saw quite a big exodus and an actual population decline in 2021. It's been quite strong in the rebound that we've seen like pretty consistently nationally in terms of that movement. But Victoria's had the extreme on both ends. So there's been a lot more volatility and still trying to catch up to that lost population decline in COVID to kind of get back to that steady state or long run expectation of population growth. When we look at the right here, we see components of population growth for Victoria. So red being the natural increase, light blue being net overseas migration, and the purple being net interstate migration. So net interstate migration is people coming from Victoria, coming to and from Victoria from another state in Australia. And what we see is the purple bars hardly moved or been quite slightly positive for quite some time. During COVID, that swung quite negative and is still quite negative. But the thing that really impacted Victoria during that time was in 2021 was actually the net overseas migration, which has been a strong driver of population growth within the state. Natural increase hasn't really moved too much and has been quite strong, which compared to the rest of Australia is quite a quite strong indication that there's probably not as old of a population within the state as you see in other parts of the country, like in Tasmania or South Australia. So the natural increase hasn't really moved too much and is maintaining quite a strong trajectory, at least compared to states where there is actually pretty close to a natural increase decline. Moving to house prices and the established market, prices have been quite elevated since 2020, but pretty much nationally. But there's been quite a flattening since 2022 for Victoria. So there was relatively strong price growth in Victoria coming out of the pandemic as there was more money sitting around. That was particularly true for rest of Victoria, so the regional parts of Victoria, which we saw quite a large exodus out of Melbourne towards regional parts of Victoria, but also interstate, and that bid up a lot of prices in those areas. Since then, there's been quite a flattening of that growth, and it hasn't been as strong as what we've seen nationally and in other comparable markets like Sydney, Brisbane, or Perth, where there's been really strong price growth ever since 2022. When you look at Melbourne specifically, Melbourne's been relatively flat, dragged by a fair bit of the units price growth, which is kind of what we expect. But there's also been quite a difference between house price growth in Melbourne compared to nationally, and unit price growth in Melbourne compared to nationally. They've kind of tracked in fairly similar ways since 2022, but houses had a bit more of a bump up and stronger growth between 2020 and 2022. This is really evident when we actually look at the price growth by price tier. So that 2020 to 2022 story, that was really driven by the high and middle end of the market. We saw a lot of the lower end of the market where we see a lot more units and those sorts of properties grow a lot more slowly. That was kind of the main reason why we saw strong price growth until then. And then ever since, we've kind of been a little bit sideways until about 2025. We saw a recent uptick in price growth, But then the high end of the market since late 2025, around about when you actually saw the 5% deposit scheme and the limits of those come online, we've seen quite a dramatic pullback in the higher end of the market and the price growth that we've seen at least since 2020. So much so that the higher end of the market within Victoria is kind of below what it was in 2022, whereas both the low and the medium are still a little bit above that point. Rental availability has improved a little bit in Victoria. Regional Victoria, so looking at the left graph here, regional Victoria has seen quite a strong improvement since the start of 2026. There is some seasonality with this when in the middle of the year we tend to see an increase in the vacancy rate. But what we're looking at here is quite a strong gain in the vacancy rate in regional Victoria over the last 6 months. In Melbourne, it's been a slight gain. It's near the highest it's been since about 2023. And that's been quite strong in terms of like producing more rental availability for renters and placing downward pressure on rents. Comparing that to the right graph, we've actually seen a bit more rental availability in Melbourne and regional Victoria than kind of what we've seen in capital cities and regional areas in the rest of Australia. In terms of Melbourne, it's only just marginally higher compared to other capital cities, but rest of Victoria is quite higher compared to other regional areas, which is a good sign for rental availability in those regions and rent growth in those regions for renters. Looking at rents now, rents have been a little bit slower in Victoria's rental market compared to the national equivalent. There's a few factors as to the reason as to why that is the case. So with Melbourne, we obviously saw quite a large population exodus, which slowed or actually declined slightly, asking advertised rents. And then there was a large upward pressure when that population growth returned. We've seen over the last 2 years or so quite sideways rental prices in Melbourne. A slight uptick recently, but nothing too out of the ordinary than what we've kind of seen, and a bit more of a settling to the long run growth that we would probably expect. Regional Victoria, even though it saw quite a large downward pressure on, downward pressure on rental vacancy rates and upward pressure on rents, it's kind of stayed about the long run trend of growth and hasn't fluctuated too much away from that. Even though we saw quite a big closing with rental prices in Melbourne and Victoria, that gap has since widened again, and we're kind of back to where we would expect that to be. When you compare rest of Victoria to other regional area rents in Australia, still a fair bit below what we'd kind of expect in other regional areas of Australia, which is a good thing for renters within those regions. Similarly, for capital cities, Melbourne's actually the equal cheapest rent capital city in Australia, level with Hobart in terms of price at $600 per week, and quite a bit below what the capital city average is, which is a good case for affordability. Listings activity has tracked kind of pretty well with last year's, so there hasn't been too much of a drop off in selling activity. In fact, it was relatively elevated at the first part of the year as we kind of saw interest rates increase a little bit. But there's no clear driving factor as to the reason why we've had a little bit more property listings in that first part of the year. Since then, it's tracked about average and well above the 2016 to 2024 average that we've kind of seen. The interesting thing about the properties that are selling is we've seen quite a big jump up, at least nationally, and a little bit in Victoria around houses selling below original asking price. In Victoria, the chart on the left that we're looking at here, the red line with the dashed little dot line that we see here, that's essentially the long run average and the time series of the proportion of houses sold below the asking price on the red line. We've gone a little bit above that long-term average, but nothing quite significant within Victoria and kind of pretty close to what we've seen previously and in previous, at least below right now, previous interest rate hikes. And when you look at the national average, it's actually still a fair bit below, but has jumped up quite a bit in recent time. So that's quite an indication there's been quite a lot of changes within the market. Interest rates have increased again. We've had quite a lot of tax changes in recent times. And so the desirability to sell below the asking price is still quite low at least nationally, even though it has increased, and we're slightly above in Victoria, but nothing major at this point in time. That's a good lead into investor activity and the budget changes. So looking at the budget changes and the policy shifts that we've kind of seen, it's likely that we'll see a lot more owner-occupier sales over the short term. So the main budget changes are obviously the capital gains discount and negative gearing. Starting with the capital gains discount, it'll use a different discount methodology over into the future from FY 2028. And that essentially reverts back to the old indexation method. So that means that a property or an asset sale will only ever be taxed on the real gains that it makes. And there's been the combination of an additional marginal tax rate of 30%. Just that's essentially the idea of a way to stop realized gains, which doesn't tend to happen in the property market, but does tend to happen with other sorts of assets like shares. So an investor would essentially realize a sale of an asset in certain time periods so that they pay less tax for that. The transition to the new methodology will occur on the 1st of July. Any unrealized gains can either be assessed at value with the proportion of that gain to that point having the 50% discount, and then any future gain to the value from there being the discount method being applied will be the indexation method, or, and this is up to the property holder, or they can claim at the time of sale a pro rata share of holding time. So if an asset's held for 5 years in the 50% discount and then held for another 5 in the indexation after it flicks over, then essentially half of the gain, any gains made, will have a 50% discount applied, and then the other half will have an indexation. New builds can still choose between the two discount methods, which is a positive sign for new builds and the purchase of new builds or investment of new builds. And principal place of residence is still capital gains tax exempt. Negative gearing has shifted from deducting losses against current income, which was the old system on established residential properties, to deducting losses against future property income gains on established properties. So essentially, and this is in a portfolio view, if you hold a portfolio property and you are making a loss and you traditionally would have been able to negative gear that, you can't actually offset that against your taxable income. But what you can do is if you hold onto the property and you've invested in it, when it actually becomes positively geared in the future, those gains that you're making, those income gains can actually be used to then offset any losses in the previous holding period of that asset. Commercial property and new builds, they're still assessed under the old negative gearing rules. And essentially that's the case for all assets except for residential property. So you can still negatively gear basically any other asset loan that you've used to purchase an asset, and commercial property and new builds still have that access. Any purchase prior to budget night can still claim the negative gearing until it's positively geared. When you look at AUSTRAC, the anti-money laundering, no doubt everyone is across this. It came into effect on July 1. There's a lot of regulation in this space where real estate agents now must verify client identities and assess basically the financial risks and report anything suspicious. That's to clamp down on money laundering activities by criminal organisations, and obviously an increase in the amount of paperwork and work that real estate agents need to do. Looking at the CGT discount for a second and its application to investment properties in Melbourne, it's a little bit more technical than arbitrary, the change. So when you actually consider whether an indexation method or a 50% discount is good or bad, the thing you need to kind of look at is, well, how has the market moved? Is it higher inflationary? Are we in low inflationary environment? And how does that kind of affect my my investment when I realize the gain? So what we're looking at here is since about 2014, when an investor bought and sold a property and how they actually made a gain, and whether they would actually pay less tax, the proportion of sales that would pay less tax under indexation versus a 50% discount. And what we see is there's actually in some instances and time periods, the majority of sales in that quarter would actually be better under an indexation method, though over time, the majority, or at least 3/4 or so, are actually better off under the 50% discount. But that's an important thing to consider when you're looking at certain types of investors and the properties that they're looking at and the areas that they're currently looking at, and whether it becomes more favorable towards income generating assets over capital deriving assets. Ultimately, they're still making a strong gain, but what you're kind of looking at here is indexation is the possibility of having a lower tax bill. Investors into Victoria have been quite strong. So that's kind of increased since about mid to start of 2023. And we're kind of at like the peak of that until March. Obviously, since then, there's been quite a big drawback in investor activity from the budgetary changes. There's kind of the expectation that that'll at least be short term or relatively short term until investors kind of realize, or sorry, not realize, but until we see yields come back to a point where we expect them to be, or investors are more interested in investing, or we kind of see the point of like um, the tax exemptions become more viable in terms of the new builds. Because of that higher proportion of investors, essentially we've actually seen quite a higher proportion of investors for sale, new for sale listings. There's been quite a big increase across Australia since the start of 2026 in that, and obviously a jump over the last couple months of investors as the higher share of sellers on realestate.com.au. That's kind of where you're going to be seeing a lot more of properties being listed and the area of demand in the market, at least over the short term, with owner occupiers potentially being the buyers as well. Looking forward a bit here, we're still not building enough houses, properties, sorry. So essentially, there are a lot of the policy changes that kind of occurred within the market. They would they were directly a lot of the property changes that kind of occurred within the budget. They were trying to cool demand, and the idea was to try and bring more owner occupiers into the market. But ultimately, supply is the problem. So right now, we have a national cabinet target of 1.2 million homes to be built over 5 years. And when you look at the chart on the left, we see houses and units for Australia. And Australia kind of needs to hit 60,000 per quarter to reach that target, which we're well and truly below. Victoria, on the other hand, is in a lot stronger position in terms of building enough supply. It's come down a little bit below the target, but there was a little bit more of an excess supply prior to the target coming in from a significant amount of apartment buildings over the 2010s, which has helped support an oversupply of dwellings within places like Melbourne in particular. And essentially, we're still lagging a fair bit behind those completions, but we're looking a lot more likely. When we look at the cash rate, economists kind of disagree where we expect the cash rate to go from here. And inflation data will kind of be the indicator of who's right there. So what we're looking at is the cash rate in the red line in recent history and where it's kind of risen and fallen and risen again. And essentially, we've got three forecasts available. So the green dashed line is Westpac, the bank, their forecast, which tends to be the most contractionary stance. The light blue line, which is the RBA statement of monetary policy, which is essentially the forecast that they release and expect in the market. The purple line there, that's the market economists, which is essentially a survey that the RBA does of what they expect interest rates to do over the short to medium term. What you can see is Westpac is expecting at least 1 to 2 more hikes over the short term, whereas market economists are saying that there's going to be a hold. Both kind of agree around mid-2027 there's going to be cuts, which essentially will mean that once the RBA is comfortable that inflation is back under control, then we're going to see a lot more easing and demand coming back to the market. Ultimately, we'll know a lot more over the next few months as more inflation data comes out, and whether the domestically driven inflation data that you saw in the earlier slide kind of is coming back down towards target band. Looking at price growth here, REA still kind of thinks that there's a lot of noise within the market at the moment, but ultimately long-term trends and fundamentals of supply and demand will drive price growth over the long term. So we're expecting pretty much every city in Australia all cities in Australia to return to some positive price growth in 2027 and finish the year relatively modestly either down or lower than where the price growth had been in the first half of 2026. Ultimately, and that's the main driver of that, is that there is too much demand and not enough supply within basically every major market in Australia and most regional markets. And until that is fixed, demand will continue to exceed supply and prices will follow suit. Thank you very much, and I hope this was an informative session.